difference just by paying attention to what the market's doing. I always get the question, the hand will go up and say, wow, well, that's a lot of work for the advisor, right? If you have to do that for every single client, manage their pad, and figure out what the market's doing, it's a lot of work. But think about from this perspective, yes, it's a lot of work. There is software out there that will help with this. But even if you implemented that for your A clients, your top 10 clients, and can show a significant difference in return over time, that's a huge value add for you as an advisor. So I'm a big proponent of value investing. Value is having a rough run in the markets, right? Growth has outperformed the last 3 years for sure. But I think when people think of value investing, they don't necessarily think of how it actually works. So why investors should love cheap stocks? I want to give you a scenario. A $10,000 investment into a particular company whose share price is $20 a share, so you're buying 500 shares. That company earns $1 per share, so its earnings per share is $1, pays 75 cents a share in dividends, and let's assume a growth rate of 7%. Okay, is everyone familiar with the price to earnings ratio? Well, price to earnings ratio simply takes the price of the stock divided by the earnings per share. So in this case, it would be 20 divided by 1, so the price to earnings ratio is 20. So when you hear someone say, when you turn on CNBC and they're saying something's trading at 20 times earnings, that's what they're referring to. It's a valuation metric that allows us to figure out how expensive or cheaply a stock is trading relative to its peer group. What if we bought this stock and the next day the price went from $20 to $10? Is that good or bad? Well, it sounds awful, right? Like if you buy a stock at 20 bucks and the next day it goes down to 10, that's not that's not good at all. But what if I told you nothing about that company fundamentally changed? Right? So it's still going to continue to earn $1 per share. It's still going to continue to pay 75 cents a share in dividends. Over time, its PE has now dropped from 20 to 10, so it's looking much cheaper. And if you hold that over time, the green scenario is if it stayed at 20 bucks a share. Over time, reinvesting those dividends, you get, over 25 years, 1,255 shares. Remember, the original investment is 500. It grows 127,000. You're getting a little over $4,700 a year in dividends. If the price suddenly cut in half from 20 to 10, and you continue to hold on to that and reinvest the dividends, you're going to get 3,049 shares. The investment's going to be worth $154,000, and you're close to $11,600 in annual dividends. That's why cheap stocks and that's why value investing works over time. Let's talk a little bit about the business cycle. This isn't going to be an economics 101. I don't want to do anything like that. But one of the questions I get a lot is, how do you figure out what the economy is doing when you're constantly inundated with various economic readings, right? GDP did this, and retail sales did this, and inflation and interest rates. How do you actually figure out where we are and what the likelihood of a recession is? Well, to be a better investor, I want you to start thinking about the business cycle and start thinking about where you think we are in the business cycle. I'll go through an example here. This is the current one, though. I want to make sure you take a look at this. For those of you at the back of the room, this may be difficult to see, but what I want you to see is the bottom of that chart, the orange line there, shows that we are currently in the longest economic expansion in history. As at the end of October, we're now 125 months into the current economic expansion. That's over 10 years. A typical business cycle normally runs 3 to 5 years, sometimes extends as far as 7. This is pretty extreme. So keep in mind, again, where we are in the business cycle. But this is pretty important to remember. And then this chart here. And what I want you to think about when it comes to economic data and thinking about the business cycle is think about what's getting better and what's getting worse. So when you read an economic indicator, it doesn't really matter. I'm not going to say not that it doesn't matter what it is, but is it getting better or is it getting worse? And then try to plot it on this grid and then try to figure out where you think the major economies are. I think that this is where I think we are. Open for debate. If you think differently, I'd love to hear from you afterwards, because again, this is what makes our industry great, is differences of opinions. But think about it in this terms. You can try to sense as to where we are in the business cycle. I would argue that we are late cycle in most of the major developed markets. We've been in late cycle for quite a while. It's being extended as the Fed continues to cut interest rates. I think this is where we are. So think about the business cycle to help simplify your thinking on where we are in the economy. I get a lot of questions about the inverted yield curve, right? And does it mean we're going into recession? If we go back a couple months, so in August of this year, the yield curve did invert. It's no longer inverted. It's an important metric, and we paid attention to it. But more importantly, it's try to remember that with the inverted yield curve, it tends to overpredict. So it's actually predicted twice as many recessions than what we've experienced. And it tells us nothing about timing. These are the last 5 recessions that we've had. And you can see the date of yield curve inversion to when the recession started ranged anywhere from 10 to 33 months. So it's not as if you see a yield curve inversion and then all of a sudden you have to run for the hills, because in some cases you're waiting the better part of 3 years for that recession to start. And if you've panicked, then you're not positioned properly and your clients are not positioned properly for the market environment. So instead of just looking at the yield curve, look at the yield curve in conjunction with a couple of things. So if you had a pending recession, you would see stress in the credit market, you would see stress in the labor market. U.S. unemployment just came in at 3.6%, which is near historical lows. Payrolls 128,000, much better than expected. So labor market's doing well. And then you'd also start to see contraction in manufacturing. That is the one spot we are starting to see things turn over. Manufacturing around the world is trending lower, likely due to the impact of tariffs and trade war. Okay, this is my favorite part. Analytics and artificial intelligence. Now let me preface this by saying I'm not an expert in this space by any stretch of the imagination, but if you're following what's going on in our industry, the pace of change is like really, really rapid, right? Like things are changing really quickly. AI analytics are making its way into our industry. So I've spent probably the better part of the last 18 months looking at some of this stuff because I want to understand it better.